All right, let's jump right in. We are going to talk about a huge problem that a surprising number of people have. What to do when way too much of your wealth is tied up in a single company's stock. It's a high-stakes game, for sure. But don't worry, there are some really smart strategies to handle it.
So let me just ask you this straight up. Is a huge chunk of your net worth sitting in one stock? Maybe you're a founder or an early employee at a tech company, or maybe you inherited a big family holding. If you just nodded your head yes, then you're going to want to pay very close attention.
And here's why we need to talk, because let's be real, you could be sitting on a financial time bomb. Seriously, one piece of bad news, one shift in the market, and a fortune that took years to build can get absolutely hammered. The risk is no joke.
So here's our game plan. First, we'll really dig into what makes this one stock problem so dangerous. Then we'll get into the good stuff, strategies to protect what you have, and then strategies to build out a stronger, more diverse portfolio. And we'll wrap it all up by comparing them so you can figure out what might make sense for you.
All right, first things first. Let's get a really clear picture of what we're actually up against here. It all comes down to a simple term: concentration risk.
So when we say concentrated stock position, what we really mean is that one single investment has the power to either make you or completely break you. It's the exact opposite of that classic advice, right? Don't put all your eggs in one basket. Well, this is having all your eggs in one basket that's perched on the edge of a cliff.
And well, this chart just says it all, doesn't it? When 90% of your wealth is in one stock, your entire financial well-being rises and falls with that one company. A 20% drop in that stock isn't just a bummer, it's a catastrophic hit to your total net worth.
Okay, enough about the problem, let's get into the solutions. We're going to start with strategies that act like, financial shock absorbers. These are all about playing defense and protecting the value you've already worked so hard to build.
We're going to dive into two really powerful hedging tools. Think of these as ways to build a financial safety net under your biggest asset. We're going to break down something called an equity collar and another one called a variable prepaid forward.
So first up, the equity collar. This is a really slick option strategy that basically puts your stock in a protective little price bracket. You get to set a floor, a price it can't fall below, but the trade-off is you also have to set a ceiling on how high it can go.
So how does this magic work? It's a two-step dance. First, you buy something called a put option. Just think of it like an insurance policy. It gives you the right to sell your stock at a guaranteed minimum price. That's your floor. Then, to pay for that insurance, you sell a call option, which gives you cash but also caps your potential profit on the upside.
And here is the really cool part. A lot of the time, you can set it up so the money you make from selling that call option perfectly covers the cost of buying the put option. It's called a costless collar, and it means you can lock in that downside protection for literally $0 out of your pocket. Pretty neat, right?
Now, our second protective move is the Variable Prepaid Forward, or VPF. This one's for when you're thinking, I need cash right now, but I really don't want to sell my stock and trigger a massive tax bill. With the VPF, you get a big cash advance, sometimes up to 90% of your stock's value, in exchange for promising to deliver some shares down the road.
And this breaks down the deal perfectly. Today, you get a pile of cash, and you get to push that capital gains tax bill off into the future. But later, you have to settle up by handing over shares. Now, the variable part is key. The exact number of shares you give up actually changes depending on how the stock does.
Okay, so we've covered defense. Now let's switch to offense. These next strategies are about fixing the root of the problem, actually trading that one giant position for lots of smaller ones. This is how you build real, long-lasting diversity.
And we're going to look at two totally different ways to do this. There's the exchange fund, which is kind of like a stock potluck, and then there's the completion fund, which is more of a slow and steady, do-it-yourself approach. All right, so what on earth is an exchange fund? Well, imagine you get together with a bunch of other people who all have the same problem you do, but with different stocks. You all agreed to throw your single, concentrated stocks into one big pot. In return, everybody gets a piece of that new, instantly diversified portfolio.
The process itself is pretty simple. You contribute your stock. It gets pooled with everyone else's, and you walk away with a slice of a much safer fund. The really big win here? This whole exchange is usually set up so you don't have to pay capital gains taxes on it right away.
But, and you knew there was a but coming, right? There's a pretty significant catch.
To get that amazing tax benefit, you usually have to agree to a long lockup period, and we're talking typically 7 years. That means your money is illiquid for a long time, so this strategy is definitely for the patient investor.
Okay, our final strategy is the completion fund. Honestly, this is the most straightforward idea of the bunch. You just make a deliberate plan to sell off your big stock position piece by piece over a number of years. And with the cash from each sale, you go out and buy a mix of other investments.
In this timeline shows you exactly how that could look. Maybe you sell 15% this year, 15% next year, and so on. You slowly and methodically chip away at your risk. The best part here is you are in complete control. You decide when to sell. And by spreading it out, you also get to manage your tax bill year by year instead of getting hit all at once.
Phew! Okay, we have just covered 4 pretty powerful but very different strategies. So, how in the world do you choose? Let's put them all side by side and see how they really stack up.
This table is basically your cheat sheet. If your number one priority is just protecting against a crash, the equity collar is great, but remember, it limits your upside. If you need cash in your pocket today, the VPF is your friend, but you are locking in a future sale. Want to get diversified in one fell swoop? The exchange fund is incredible, but you've got to be okay with that 7-year lockup. And finally, if you want total control, the completion fund is perfect, but it's a slower journey and you'll be paying taxes as you go.
Now, before we finish, I have to stress this one last point, and it's incredibly important. These are not weekend DIY projects. These are complex, sophisticated financial tools. Our sources are all very clear on this. You really should only do this with the help of a professional financial advisor who can look at your entire picture.
So we'll leave you with this final thought. You now get the risk, and you know 4 very real ways to manage it. So if your wealth is concentrated, the only question left is, what's your next move?